G'day guys, welcome to the Pumped on Property Show podcast. You've got Ben and Simon here today. How you feeling?
Hola, yeah, really good. Nice little surf this morning, wasn't it?
Yeah, we just got out of the water. Little bit windier, but still got some fun waves.
Managing to social distance out in the water as well. It's probably a good place to do it.
Just feeling so fresh. Like I deliberately woke up this morning at 5:30, went and did like the little stretching routine that you and I have been into at the moment with the Paul Check stuff, and then went down the beach, had a surf, took the dog down, and then just grabbed a little bit of food in the sun just then. And
it's been nice, hey, like working from home and just having that little bit of extra time in the morning to do your little routines. And, you know, even though we got up for a bit of an earlier surf this morning, same thing, like made sure that I got up, did a bit of stretching, did my journaling and meditation, things like that, just setting the right intention for the day regardless of how it begins.
Fully. Like I was just out there, out the back of my joint, and that's where I'm going to do my stretches now. I've just like set up this little deck and I've got my little fit ball out there and my little yoga mat, and it's just so nice. Like there was, you know, literally watching the sun come up through the trees and just being in nature, hearing the birds. And every time, like all of our minds are at the moment, my mind was running off and thinking about work or thinking about the future or thinking about the property I'm going to buy this year or the market. Just coming back to the breath, like looking around, observing nature, and it was super helpful. So we did another video recently on that. It's on our YouTube channel if you want to check it out. It's also on the podcast too, just around some of the things Simon and I have been doing during this particularly stressful time for some of you, to just keep yourself in flow and keep yourself in balance a bit more as well.
Yeah, for sure. Now, today we're going to be talking a bit about property investing in 2020, who should be and who shouldn't be.
This is going to be a really solid podcast. So there's what I've been finding, two very different types of people in this current market, and you would be feeling like this as well. There is the person who is in a great position, and we'll talk about if that's you. And there's the person who's been absolutely freaking out, that's living week to week, that doesn't have any savings, that's in fear of losing their job or just lost their job, that obviously this time is going to be particularly damaging and difficult for them. So we'll talk about the people in a good position first, and, you know, what is a good position. We're going to talk about planning for the year, making the decision to buy or to sit on the sidelines for 2 years, which could 100% be a decision you make. We're going to talk about, is now the right time to buy, where to buy, as well as what to buy, using all of the data that we've been looking at the moment. And then if you're doing it tough at the moment, in the second half of the podcast, we're going to talk about a bit of a plan B, C, and D for you guys. We're going to talk about what a tough position looks like, what you can do to protect yourself, what you can do to leverage off the government support available at the moment if the worst case scenario happens to you. You know, tips and tricks for managing properties if you own them now and you're worried about vacancy. Tips and tricks for getting some of that government assistance through to you a bit earlier. And if you get in really hard financial stress, tips and tricks around leveraging off some of the banking changes at the moment to protect yourself and freeze loan and things like that too, as well as a plan, because just because you're doing it tough now doesn't mean you want to be, you know, broke for the rest of your life and doing it tough and ending up on the pension. You know, where you are now is the result of what you've done, but you can completely use this time to plan for a better future as well.
That's 100%. Like, I've been talking to a lot of my friends that have unfortunately lost their jobs, and my message is always, you know, don't take this the wrong way. You know, look at this as an opportunity to spend some time doing those things that you have always wanted to do, but you never have. And you know, if you were planning on getting into property investing and now it looks like it has been put on hold, it's a great opportunity to just spend that time making sure that you do educate yourself and you do start learning how this crazy world works when it comes to investing.
You know, there's been times in my past where my mortgage broker literally said, you can't do anything this year. Then I go to him the year after, you can't do anything the next year. And then I go to them the year after and I couldn't do anything. And I literally had to sit on the sidelines for 3 or 3.5 years.
It's a boring world, the waiting game of property investing, isn't it?
Yeah, like you're generally waiting to either buy something, you're waiting for a market to pick up or a market to crash. You're waiting to save the money. You're waiting to spend the money on the right asset. You know, it's just one of those things. Like in the last 10 years, I think if I looked back, I've probably only spent 2 years actually buying stuff, like 2 years worth of time. And the rest of the time I've just been sitting there saving or waiting or strategizing. And, you know, this video is going to give you a hell of a lot of gold.
So Ben, you've probably had close to 60 one-on-one strategy sessions over the last month. So that's given you an opportunity to talk to a lot of different investors in a lot of different positions. And obviously all of them coming to you for a little bit of feedback about their situation, what their plan is. So starting off for those people who are in a good position, what has that looked like?
There's really two types of people that are coming to us in strong positions at the moment. There are people like myself and Simon who are in a long-term or a relationship. They've either got one or two incomes. You know, some of those people have children, others don't yet. Basically, because of the combined income, they've been able to save money. You know, we're talking about people with somewhere between $60,000 and $100,000 plus of savings or equity. A lot of the people that have been starting to reach out to us have been saving literally since the last GFC for this market, and there's people coming into our business with a lot of money. The incomes look on average somewhere between about $70,000 a year combined up to $1 million a year combined. You know, good savings in the bank, good equity, a low risk of jobs. You know, they're not in hospitality, they don't own a gym, they're not in the travel industry or the hotel industry.
Most people in that essential services, as Scott Morrison's been tagging it.
Yeah, you know, people in construction, engineering, IT, legal, doctors, nurses, healthcare professionals, you know, people in the stable parts of the economy right now that the government is really encouraging to continue to move forward. And to be honest with you, they're the types of people that we've always worked with.
Yeah.
You know, we rarely work with too many people in, you know, the lower end of the market in terms of the incomes, just because for whatever reason, a lot of those people aren't really thinking about much more than the week that they're currently in, unfortunately. So a strong financial position means not having overwhelming debt on your own home, not struggling to be making repayments. If you've got investments, like good quality assets that aren't costing you $20,000, $30,000, $40,000 a year to hold, people that have a buffer in place, whether that's savings or equity for a rainy day, and that if one of them or both of them were to lose their jobs, they're not going to be completely overwhelmed. And you know, if you're in that position now, you feel strong and financially secure. You know, people that bought property 3, 4, 5, 10 years ago that have been sitting around and waiting for this type of marketplace, you know, solid income is what we're talking about right now.
It's a huge demographic out there right now as well. Like, yes, a lot of people have lost their jobs, but basically every single person that we've been talking with have been in these good situations, and it's been a nice breath of fresh air to talk to such positive people that are just ready to grab this market by the balls.
The other person that we've been talking to a lot is obviously you guys out there who are single or in early stage relationships where you're not coming together. Again, your financial position is strong because you've either got some cash in the bank, you've got a good income, you've got some job security, as much as job security as you can ever have, because there's really no such thing in any market as job security. You know, some equity in your properties if you own them, or good cash flow from the properties if you own them. You know, just, you know who you are again if you feel like you're in that sort of stable position. The most important thing at the moment to me, and we've been deliberately not taking on clients who just don't have a rainy day buffer. So, you know, if you don't have $20,000 to $30,000 left over, maybe even 50 grand left over in either equity or cash after we buy something, then we've been saying to those people, hey, we're happy to help, but let's just save for another few months to get that buffer up and to give you guys a breathing space, because the last thing we want to see is anyone in this time lose their job without a plan B and then have to ring up the bank and freeze their loan, or lose a tenant and get stressed out on paying rent.
Like, it is lucky that the government has put in some of these incentives to help people in those situations out that don't have the right plan in place or don't have those right buffers in place. But obviously we want to work with those people that are obviously, you know, crushing it and have been putting that money away for a long period of time. And
so many people have, man.
So many people
are in really strong positions to capitalize on this type of market, which leads me into this question. is now the right time to buy. Now, Simon and I have been looking at the last 4 mid-cycle slowdown points. So that's 2020, 2001, 1981, 1961. The hardest thing for most of us to separate right now is this idea, and George Soros talks about it. It's one of the most famous investing quotes of all time. And the quote is, "This time it's different."
Yeah.
It's one of the most dangerous things any investor can say, because a lot of us out there at the moment think that this is the first time we've been through this type of market, because that's what the media is saying. A lot of people are sitting there going, I don't understand the history, so I don't know when this has happened before, if it's happened before. And a lot of people have a recency bias, which is affecting their short-term judgment. Things are bad right now, but over time, things will get significantly better. And we'll talk about that later on in the video, why.
Yeah, it was interesting to look at all of those previous mid-cycle slowdowns and how much it did affect the share market in particular. And every single one of these mid-cycle slowdowns was brought on by a significant event at that point in time. And most of the time there was talk that we're never going to get through this. But lo and behold, we always have, and the world has continued to spin.
So what I want to do is break that up. Now, what I've done is, like I do, I've seen a pattern in it. So the way that these mid-cycle points start is there's a extremely strong bull market, which is a rise in asset prices in the stock market and land prices around the world for about 7 to 10 years generally. Then what happens is all of the asset prices, like everyone has known the American Stock Exchange is completely overvalued now for 2 years. Everyone has known that the Sydney and Melbourne prices, as well as London and New York, are overinflated, as well as a lot of other markets around the world. But people have continued to get on with life. And so what happens is we get this bull market where prices run up based on really, really cheap and easy money. And then we get the first step in the process is a triggering event. So in 2020, the triggering event will be known as coronavirus. In 2001, the triggering event, which everybody that's my age can remember, is a plane flying into the New York Stock Exchange, which is 9/11, as well as the .com crash. In 1981, the triggering event was our poor parents getting interest rates up to 15 to 18% globally, which absolutely crushed the market. And that was the triggering event. In 1961, the triggering event was
the Cuban Missile Crisis.
Yeah, like people literally worried about Russia and America blowing up the whole world.
Blowing up the whole Northern Hemisphere at the least.
That scared the entire world until the president sorted it out. So there's a triggering event, and then what happens is there's a period of decline. Now, in the mid-cycle point, the difference between mid-cycle and GFC historically is in a GFC and a mid-cycle stock prices get smashed, but in a GFC, we generally see property prices get absolutely hammered as well, where in the mid-cycle point, there can be some damage to some markets, but it's generally a lot softer from a property perspective.
And what we've got in Australia as well that you have to remember is 2017, 18, and parts of 19, we had a pretty sharp declines, the biggest declines in the property market for over 20 years.
Yeah, so, that's beautiful until prices run up in Sydney and Melbourne by 15% in the last 6 months. But, we'll talk about that more in a moment. So you've got a triggering event and then you've got a decline. Now, generally what happens in 2020 so far, we've seen a 40% decline. 2001, we saw a 43% decline in stock markets. 81, we saw high 30s. 61, we saw high 30s as well. Sometimes I'll just say, sorry, bro, property prices generally drop between 0% and 15% depending on the markets around the world.
Yeah, and one thing that you've got to remember when we're talking about these historic events, obviously the 60s being the high 30s, the 80s being the high 30s again, 2000s being around 40 and this one being around 40 again. What people are saying is the world is getting globalized more and more and more so. So the world is becoming more and more connected. In turn, what that results in is larger gains in these bull runs, and it also means larger declines in these recessionary periods as well. So this will likely continue to happen, bigger run-ups and new highs, and then faster, sharper run-downs and bigger lows as well.
It's a good point because, let's take it back 100 years. Australia was Australia. America was America. People speculated on America and Australia from overseas, but absolutely nowhere near as easily as you can now. I can literally jump online right now and buy shares in America.
Yeah.
I can buy them in China. I can buy them in India. And so you've got really sophisticated investors around the world who are looking for opportunities, not just in their own market like we used to, but globally, which means there's trillions of extra dollars going into marketplaces that wouldn't have been there. And therefore they get bubblier and they bust harder. And we'll continue to see that as we move forward, as Simon said, with sharper declines as money from all around the world runs out, not just local money.
So what happens now?
So effectively we get this decline, which historically has lasted for between 6 months and 18 months in terms of this mid-cycle point. Generally what we see is two types of recessions. A V recession, which is a short decline and a short improvement, or we get a U-type recession, which is what they're expecting at the moment. The Commonwealth Bank, they're saying there's a 60% chance of that. And effectively that means we're declining. We hit bottom for a little while before things start to improve. And that's more likely what's going to occur now. And that's historically what's happened in the last number of times. So we're 100% in for a technical recession in Australia, which is 2 quarters of negative growth. But with the government throwing, $350 billion on the fire to sort of put this thing out, that's also going to result in a boom in asset prices in Australia like we've never seen, because all of that money will ultimately end in the people who own businesses' hands and the employees' hands. Those people will spend money on properties and they'll spend money on the stock market in the future. And that's going to drive both of those markets up. This is money that wasn't in the system a month ago. This is an extra $380 billion that was printed for this purpose or borrowed for this purpose, which is flooding the markets with money that we've never seen before.
I think something that you mentioned there is worthwhile talking a little bit about, and it's this idea of economic rent that Phil Anderson talks about, and you briefly touched on it there. But Phil Anderson talks about this idea of economic rent where all of the gains in society end up back in the property prices. So what Ben was referring to there, talking about all of this cash that's been printed or borrowed from the government's being handed out to everybody that's lost their jobs at the moment, or people that were already on welfare, all of this is going to flood back into the economy in one way or the other. And what Phil believes is that eventually all of this economic activity ends up going into the land prices. It allows people to continue speculating on the land, which essentially is going to drive up property prices.
Completely. It's a theory that people have had for literally hundreds of years. And it's as simple as going, let's say Bondi Beach in Sydney is a premium location because it's the closest beachside suburb to the CBD of Sydney. You've got hundreds of thousands, if not millions of tourists a year that come through that area, as well as the locals that want to live there. And so the economic rent or the land value in that particular area, because it's more desirable, results in higher land prices. And that's what happens. So, Bondi Beach prices, if it was just based on the average person in Australia's or Sydney's income, should be sitting at probably $1 million. But because you've got people from all over the world that want that lifestyle, and you can make these extra gains on Airbnb and stuff like that in that area, or you get these extra returns because, a very wealthy Russian guy comes over here, he likes Bondi and he wants to buy something, and you're competing with internationals. All of that money goes into the land price and drives it up. And then on the flip side, maybe you've got a marketplace like Dubbo, for example, which again is a really beautiful place that I've been to, but because it's just a local land market that's 100% capped on, local economy, the land prices don't go up as far. And if you look at Dubbo, sites further away from the CBD that aren't as good quality sites for agriculture and farming are worth less, where good quality agricultural sites or sites close to the city are worth more. And that's how it's always been since we started settling in places.
What I love about economics, when you break it down like that, it isn't too difficult to understand and explain, and it is super logical.
Super logical. So
I guess the question, is it the right time to buy?
I don't know. I just want to be straight up with people. I don't know if it's the right time for you to buy. But for me and Simon, I plan on buying at least 2 more properties this year.
I plan to purchase my 3rd property within 2 years, it will be.
And it's not because it's this year, it's because that's my plan. So right now, I'm currently short $70,000 a year of rent because I sold some properties a few years ago. So I need to buy 2 houses and build 2 granny flats on them, which will give me the 70 grand of rent that I'm missing, which will allow me to achieve my financial goal in the future. Now, it just happens to be, with or without this, like I talked to you 2 months ago and I said I'm looking to buy when things looked really positive. Now that things look negative, I'm still looking to buy. I just now might be able to buy them for 5 or 10% below what I could, which makes me even more excited now that I'm starting to wrap my head around it.
So yeah, essentially we don't know, but there are some leading indicators that we do really like about the Brisbane market at the moment. The fact that it's more affordable today compared to 12 years ago, once you factor in inflation, according to CoreLogic, is a huge signal. The rate of population growth and interstate migration over the last few years has been the highest it's been for close to a decade. We had a huge infrastructure boom, and a lot of those projects are now finished or will be finished very soon. So there's lots of good things that are happening in the Brisbane market at the moment. It's super affordable when you compare it to other areas. You're still getting amazing rental yields. You can still purchase nice big pieces of land close to the CBD. So to me, that looks like a really interesting opportunity, which why times like these don't stop my plan and don't stop my strategy. I'll keep moving forward.
You know, for those of you who are in a strong position, the next 18 months could be one of the best buying opportunities in the last decade and one of maybe 2 or 3 opportunities that you'll have over your lifetime, because it's really only once every 7 to 10 years where everybody, including the market, shits itself and is running away. And if you can be one of those people that need to run away, then, you know, you just run away and come back in 18 months or 3 years when everybody else feels calm again. But if you're one of those people that can actually sit in the uncomfortableness of all of this, logically and strategically create a plan that works for you and then confidently move forward based on a good quality, safe and confident position, then there are deals to be had right now. Now, we're not talking about an Australian market, because what we really have is a Sydney and Melbourne market, which is up 100% from where it was 15 years ago. And then we have the rest of Australia, you know, Perth being cheaper than it was 14 years ago, Darwin being down 35%, South Australia being cheaper than it was 10 years ago, Brisbane being cheaper than it was 12 years ago. You've got all of these secondary cities that have really strong potential and really strong indicators leading into the second half of this cycle after this time that are also producing extremely strong cash flow. And, you know, you can buy them. Some of these suburbs we're buying are 15 to 20 cents in the dollar compared to Sydney and Melbourne now, like very affordable. So going from there, the next point we said was sort of planning.
Yeah, which we've talked a lot about and mentioned a few times already. Having a plan is hands down the most, what's the word that I'm trying to think of here? Comforting feeling to investing, knowing the way that the property market works and then having your plan to achieve your goals is something that's helped me maneuver through these tough times and uncertain times so much easier.
You know, planning's as simple as this. You can either jump on our website, www.pumkedonproperty.com, book in a free strategy session with myself or Simon. If there's no sessions, give us an email and we'll find time to slip you in. And if you don't want the support of someone like us or the ideas of someone like us, then all you need to do is look at your current financial position, look at your goals for the next 12 months, look at where you want to be longer term, look at honestly what's holding you back right now, because if you're not already financially free, you either are too young to have achieved it and haven't been following your plan for long enough, like Simon and I, and there hasn't been enough time in the market for it to come to fruition yet, but you will get there, or you just don't have the right plan in place and you've been self-sabotaging and something's been stopping you achieving the life that you want to achieve. And I don't mean to be brutal with that, but there's a reason. If you're working your plan at the moment, that's cool, it will come. But if you haven't started, then, you know, there's something holding you back, and addressing those things is part of this. And then from there, identifying, which state, which suburb, which type of property you'd like to buy, which we'll talk about a lot more in a moment, and just getting really, really clear on your plan for the property, how much you want to spend, how much buffer you want to have left over so that you're in the best position you can be.
Definitely. Once you've got your plan, what's the next step?
It's making a decision. Like I said a moment ago, you can do nothing for the next few years and just wait and see, like a lot of people will, and that's completely cool. If you're in a tough position right now, that's absolutely what you should be doing. If you're in a good position but you're just like, I'm just going to wait and see 18 months, absolutely do that. But I suppose if you're in a strong position, it's going to take making a decision to put in a plan and actually move forward with your goals to get through this market, because everybody else around you right now is going to be saying, don't
do it.
And that's completely fine because they don't know what you know. But if you have made the decision that you are going to get your plan in place this year, you're going to save that money and you're going to invest it in the right asset, then like I said, it's a once in a 10-year buyer's market.
Definitely. What was the article that we read yesterday when it comes to getting into the market? It was Warren Buffett from someone, and he was saying that he's got $132 billion US dollars ready to jump on the stock market, was he saying?
Yeah, like $130 billion of cash waiting to jump into the market, and he's just started to rebuy.
That's a pretty good indication. One of the best investors of all time is jumping in already.
Well, 18 months ago, Warren Buffett also said that he's going 100% into cash because the risk doesn't necessarily warrant like in keeping his money in the market for the year and a half that's just passed. Now, a lot of people got good returns in the last year and a half, but that 17% you made last year is now minus 40 to 50% depending on your stock. It's like, does that short-term gain last year warrant the risk for this year and the downside? For me, absolutely not. So it's exciting to see conversations like that because, people like Warren Buffett, Ray Dalio are always leading indicators. They do care about educating people and helping them make better decisions. And, if you can listen to a few of those guys, maybe you can, massively increase your returns.
Definitely. So we've found out we are in a good position. We do believe it's the right time to buy. We've made the plan. We've decided to do it.
Yeah.
Where are we going to buy and what are we going to buy?
More importantly than ever before, fundamentals are everything in this market.
100%. By the way, this cup of coffee is delicious.
Is it? Did you make it off the...
No, we got it. We just went down to the coffee shop by the beach at
Ben's. You poured it into the cup?
And I poured it into the cup. It's a tasty cup of coffee.
Yeah, I mean...
I've been buying coffee these last few weeks to just try and reduce my expenses as much as I can to increase my savings. And this is the first bought coffee I've had in ages. It's so tasty.
That's the number one joint on the coast on TripAdvisor for coffee.
Is it? There you go. I agree with that.
I don't drink coffee, but that's what Lisa tells me.
Sorry. Anyway, coming back.
So fundamentals are very simple. We buy houses because they've done 96% better than units in the last 20 years, according to CoreLogic. We buy metro markets because they've done 86% better than regional. We buy within 20 to 25 Ks from the city because we've historically seen that buying closer to the city obviously results in higher land prices and better return on investment longer term. And then I also personally have a flavour towards buying to the beach. There's no data to suggest that it does better, but I've looked at the suburbs in Sydney and Melbourne, and beachside has absolutely smashed the performance of non-beachside.
100%. Land size, another fundamental that really comes into play. It is the power that's in the land. It's the land that's going to appreciate in value. So the larger portion of land that you can get, the better.
Go for minimum 600 blocks at this time.
Minimum 600 blocks at this time.
Other fundamentals before we get into like where to buy is once you've identified like a state, let's say that you've identified New South Wales and then you've gone Sydney because that's the metro market. Then you can look at Sydney, and if you look at it on paper and you overlay all of the sales across the different parts of the city, you can see that the northern beaches, eastern beaches and southern beaches is the highest concentration of wealth and the most premium parts of the city. So for me personally, it wouldn't be just good enough to buy Sydney. I'd then want to be in one of those three better areas. And then within those three better areas, I do the same thing again. The best suburb in like South Sydney, for example, Cronulla Beach. And then in Cronulla Beach, as a fundamental, I would then want to look at the best area, best street, best part of the suburb with the biggest piece of land and the best, highest quality and largest home I could afford.
100%. We are quality. Like, quality matters to us big time. So think about those quality areas in the market that you're living in. We actually did a video a couple of weeks ago on why fundamentals matter. So if you want to head over to the YouTube channel and check that one out, we break this down in a lot more detail. So that's kind of the what. What about the where?
In terms of the where for me right now, so I'm an active investor who's actively looking to buy properties this year. So for me, Sydney and Melbourne are just completely striked out for the simple reason that incomes don't support property prices right now at 10 to 12 times your average household income. I don't see value down there. I also don't like buying at the top of a market, which is where I see them at right now. 100% gains in the last 12 or 15 years just doesn't represent value for me at this time. I also buy not just for capital growth, but for rental return. Mm-hmm. And I'm not going to go spend $1.3 million to buy 5 suburbs away from the beach in Sydney right now to get $600 a week of yield. Like, I'm not an investor that's prepared to lose 30 grand a year on negatively geared. So Sydney and Melbourne are striked off. Perth is starting to look better to me, but there's 3 issues there. One, vacancy rates are still very high, which in a market like this doesn't give me cash flow security. People are leaving Perth in the absolute drove still. The population is still negative. And unfortunately, there's still an oversupply of property over there from the last boom. So until I start to see the population moving again over there, I'll be avoiding Perth for now. Again, long-term fundamentals for me are Sydney, Melbourne, Brisbane, because that's where 75% of the population and job growth is going.
Yeah, they get the lion's share of the population, job and infrastructure growth.
If I look at what SQM's saying, what CoreLogic's saying, what Heron Todd White is saying, it's all pointing towards Brisbane.
Yeah.
As Simon said before, there's some good stuff happening, but most importantly, it's the biggest market at the best stage of the cycle, at an extremely low price point where I can buy walking distance to the beach for under 500k. I can buy within 12k's of the city for 550 grand, or I can buy 20k's away for just over 400. And so for me, that's where I'll be looking. The parts of Brisbane that in terms of Brisbane that you want to be in is the city centre, East Brisbane or North Brisbane. They're the better quality areas of the city. And then within that, there's obviously all the little local things that we look at when we help people buy.
Yeah, making sure that you overlay all of those fundamentals once you get to the Brisbane market.
So that's my where for this year. I'll be buying Brisbane, North Brisbane on the beach. In terms of what, minimum 600 square metre block. I'll be looking for 2 properties that are exactly the same. Knockdown places is what I'm personally looking for this year. I'll be looking to spend under $400,000 to find them near the beach, if I can, otherwise up to $420,000. And then I'll be knocking them over and building a 4-bedroom home as well as a 2-bedroom granny flat, aiming to get about $750 to $800 a week of rent return from that house and granny flat, setting it, forgetting it, getting my 12 or 13 grand a year of tax benefit. And that's the what for me. But if you're not in a financial position to consider something that expensive or to knock down, or you don't want to build, then there's incredible opportunities around the buying high quality existing home space or buying places that need a renovation. And then if you feel comfortable with it, adding a granny flat to massively increase your income.
Exactly. And you've already got the existing properties in your portfolio plus the new ones. We're quite active investors, so we like the projects, the opportunities where we have to get our hands dirty and spend a lot of time and money getting these properties to where we want. So then we can, let's say in 4 or 5 years time, once we've knocked the houses down, built the dual locks, we don't have to worry about it for 15 years then.
Yeah, like I'm obviously same as yourselves, like making some money and I'm paying tax on that money. And the reason I go brand new is because there's an opportunity there in Brisbane on the beach at the moment to do that. And also the rent return's strong. As Simon said, the maintenance is low. I get a short-term capital gain, and I also get very strong cash flow. But as Simon also said, I've got existing properties in my portfolio that need a renovation and a granny flat, which I'll also work towards in the next couple of years as well.
Perfect. Now, let's go to the flip side. For the people that are in a bit of a tough position at the moment, we'll kind of walk through a similar sort of format. There's obviously a lot of people that are going to find themselves in a tough position over the next 6 months. You've probably talked to a fair few of those people over the last month or two as well. What would you typically be telling these people that you believe in a tough position, and what is that tough position?
Sure. Like, a tough position is you're living week to week. You don't have a savings buffer in place. You're renting and you're finding it difficult to repay your rent. You own an expensive home that you bought in the last couple of years anywhere in Australia, and you've just gone from 2 incomes to 1 income, and now you're feeling financial pressure. Or you've unfortunately, like worst case scenario, lost both incomes right now. Or you were in a strong position with a high income, but now you've lost it, and you've got investment properties or your own home, and you're sort of drowning. You've got kids in private schools, and your cash flow is just going backwards. Or you've got a couple of months worth of buffer in place, but if anything was to change, you'd be in a vulnerable position. So they're the people that we're speaking to. I haven't spoken to many people like that. Like, it's crazy the number of people in good positions that have been reaching out to us. And the reality is these strategy sessions, guys, are fully reserved for people that can take action. Unfortunately, I'm only offering 15 to 20 of those between Simon and I a week at the moment. They're booking out 2, 3, 4 weeks in advance. And I can't have sessions with people that are looking to just make a plan for 5 years from now. They're really reserved for people that are coming through, especially because we've decided to limit the number of people we take on for the rest of the year again. We're not just going to take on everyone that wants to work with us this year again.
But that doesn't mean you can't do anything. We've got thousands of hours of content on YouTube at the moment that you can go back to if you are in a bit of a tough position at the moment and your plans have been put on hold by 6, 12, 18 months. Go refer to that and listen to the videos, get yourself educated, read the books that we suggest in a lot of those videos, follow the resources that we suggest in a lot of those videos as well, and take this chance, as I was saying, as an opportunity to get yourself educated and build your plan so that as soon as you get your job back, as soon as your incomes are back and you are ready to take action, you then don't have to start that process over.
Completely, man. Like, what to do to protect yourself in this position. Now, Simon and I have both made really tough decisions since we got back from Cairns a week and a half ago. I can't believe it was only a week and a half ago.
I know, right? Feels like a lifetime.
Did we do a video on this last week?
We did actually.
So we went really, really deep into ideas to massively reduce the cost in your life. But, without going back through that, because that was a good half an hour video with heaps of ideas. The simplest thing is to identify what your expenses are right now. Look at what the fixed costs are. Fixed costs being home loans, rent, insurances,
electricity,
phones, stuff that you can't avoid, food. And then there's the variable. So what I did is I first looked at all of those fixed items. Most people look at their variable. It's super easy to go, hey, I'm just going to have 1 coffee a week this week instead of 7 or 14 or whatever you normally buy.
Get out of here.
28. And
35.
Then this man's wide. But variable costs are just like, if you're going backwards and you can change your lifestyle to stop going backwards, fuck, man, like, stop spending money on all that stuff. Like, this week I cut my gym membership. I got rid of the personal trainer that my wife was working with. She's
so upset about that as well.
We've got a mad home gym, but he's a really good looking dude. So I probably won't be getting as much now. Not coming home once a week excited after the session.
Maybe be the flip side.
But I got rid of those types of things. What we did on the other variable side is we did have a house cleaner, which we were lucky enough to have. Cut the house cleaner, cut the gardener, cut the pool person. All those things, you might not have had those ridiculous expenses that I've had, but I've had them, and I was able to save myself about $600 a week between all the food and all those different things that we're doing just out of luxury. And that's a luxury market thing. That's a blue market. You're making okay money. You know, couldn't be bothered cleaning your house because your wife and you keep fighting about it, and so you just hire one. But then stuff gets hard, and, you know, we're cleaning the house ourselves again, no problems, happy to do it.
Like, we were fortunate enough that our parents taught us this from a super young age. Like, they did a lot themselves, even though mum and dad were in a good financial position from probably, you were the age of probably 15, I was about 7 or 8. And, you know, they taught us that those things are a luxury, like going out to dinner, going out to lunches, going out to breakfast, you know, buying yourself new things, like clothes, for a surfboard or car or all this stuff. These were all massive luxuries, and we've been taught that for a long time. But I know a lot of my friends, especially my mates from Sydney, that got a trade out of year 10, like left school in year 10, got a trade. By the time that they were 22 years old, they're earning $100,000 a year, and they're spending $80,000 per year. Like, you know, you really got to look at those variable expenses in your life and clean them up in times like these. And as Ben said, save that for the good times and, you know, knuckle down through the tough times.
Yeah, like, you know, sit down tonight if you're in a tough position, and instead of freaking out about this, use it as an opportunity to simplify your life. You know, I had to save some costs in my business. So after looking at the variable costs and cutting all of them, and it took me one day, I just unfortunately sent a bunch of text messages and I'm like, I'm sorry, this is over now, but we'll kick it back off when things get good again.
These aren't employees, by the way.
You know, no, they're not employees. In the business then, we looked at some of the line items and we went, okay, we've got to make some tougher decisions. We were going to move into a more expensive new office and fit it out. We've decided to stay where we are. Like, we had some online costs that we no longer needed. We've cut those out. We've got a plan A, B, and C for our staffing over the next year and a half so that we don't have to wait for the marketplace. We can respond if things are looking worse. But the weird thing is, so many of you guys have been waiting for this market that we've actually just had a record month. Like, people are coming to our business in droves at the moment because they want to take advantage of this time. And then I looked at the fixed costs in my life, and in the last week since I got back, I've just gone interest only on 2 of my home loans. That one decision is going to save me this year alone about $25,000 in principal.
Huge.
Now, yes, I'm not going to own the property as quickly as I was hoping to, and I'm going to pay some more interest, but it gives me breathing space. I've got 2 more loans that I'm going interest only at the moment that I couldn't just flick over in a day. So that's helpful too. I've gone from like Vodafone Mobile to Audi Mobile, and I'm paying, instead of $100 a month, $25 a month. I've just looked at all of my insurances and absolutely hammered them down. You know, I've put my money in the right offset accounts, so I'm saving the money on the things that I possibly can. Like, just little things in terms of food, not eating out, so we're buying at home, and, you know, we are shopping at Audi in the local farmers market instead of stopping in every second day at like the shop on the way home because it's convenient for the day.
Exactly. So there's a lot of money to be saved there to reduce your week-to-week expenses. Now, something that's been great is the government's response to the coronavirus at the moment, and how much they've been just throwing cash at it to kind of try and fix the problem. And even both parties, Labor and Liberal, like even Labor saying, yeah, good work, Scott Morrison, like you're doing the right thing at the moment. So why don't we talk a bit about what the government is doing to make this a little bit easier for those people in tough positions?
You know, so if there's, again, 3 groups. There's business owners, there's mums and dads like us, and then there's people who are renting and at the very, very, you know, most affected part of this position. And if that's you, you know, I feel for you because it is tough. Now, if you're a tenant and you can't afford to pay your rent, there is, you know, no way that your landlord in the next 6 months can actually legally evict you. So that's the first and most important thing to know, that you have a roof over your head which is secure and backed by the government now.
Yeah.
If you have a home loan and you are struggling to make payments on your home loan, ring up your bank today. You can now, because of this bailout the government's given the banks, they'll actually give yourself 6 months. You can freeze your interest repayment so you do not have to pay $1 of principal or interest. I don't know how you comply with that. Like, I don't know what you have to prove, but they will give you 6 months without paying $1 on your home loan or investment property loans potentially if you're really struggling. Now, that might just be long enough for you to find a job again. A tenant again. It might be long enough for your partner to go back to work or to find a second job. There's options there. And if you've just lost your job and you've been at your employer and you tick the boxes, you can talk to your employer, and the government's now paying that employer $750 a week towards your wage, which might just keep your head above water in this particular time, and that's powerful. If you're a business and you've been really, really struggling at the moment because your income's dropped dramatically, but you've still got these overheads, then absolutely wrap your head around the government incentives where they'll pay you that $750 a staff, where they'll credit you for your employee tax roll over the next couple of quarters, where they will delay your payments on tax from last financial year in this new year.
Up to a $250 loan as well, interest-free loan.
There's also the $250,000 loan, which you can apply for interest-free for the first year, 2% interest for the next couple of years. There's lots of money going out and around that you need to wrap your head around and figure out how you can figure it out. But what I've learned from most people is they don't take swift enough action soon enough. You need, if you're in a tough position right now, to reduce your expenses to the lowest common denominator and to get the government assistance so that you've got cash flow now.
Exactly.
Because cash flow is what kills you.
You have the time to do it if you are in that position at the moment as well.
So the government's doing a heap of stuff. In terms of a question that we actually scratched out, but I will touch on it, how long this is going to last, based on previous cycles, between 9 months and 18 months for like a moderate recovery. But it could last longer. It could be shorter than that. We've got absolutely no idea. All we can say is that if you're doing it tough or if you're doing it well, set yourself up, get yourself a plan, and, you know, take the right action to protect yourself. And if you're in a strong position, take the opportunity to pounce on the market, buy stocks at 40, 50 cents in the dollar, you know, strategic ones, if that's your gig. If your gig's crypto, if your gig's gold or silver, if your gig's businesses and buying them, or if your gig's buying properties,
there's some deals.
Stuff's on sale right now, and there's big opportunities around.
For sure. And the last thing for the people in a tough position, which we've touched on, is create that plan, spend the time making sure you're figuring out where you want to be in the future and scaling that back to what you can do right now in order to get a little bit closer to that. Because as soon as you're out of this tough time, you really want to take advantage.
You know, I don't think you ever want to feel like you feel again right now if you're doing it tough. And if you're in a good position, I don't think you want to have the stress, honestly, of worrying about whether you should buy or you shouldn't buy. You know, you're never going to perfectly time the bottom of the market, but we are in a marketplace where there are stuff on sale. So it's important to recognize that, like, no matter where you're at, I think working towards financial freedom so that next time this happens in 7, 10 years from today, or 5 years, or whenever it comes around, you're in a position where you don't have to worry about losing a job. You are producing cash flow. You don't have to stress about selling a property. You don't have to get on government assistance because you've set yourself up. You've set your future family up. You've set your current family up for what it is that you want in the future. And ultimately that is choices to not stress and to take advantage of these times and to just live your life, the best version that you have and that you can.
Definitely. So if you are in a good position, if you haven't lost your job, you do have a good amount of savings in the bank or a good amount of equity there, you do have that plan in place. You know that right now there are some absolute deals out there for you. You know where you want to buy, you know what you want to buy, or if you don't know where or what to buy, please jump over and book in a strategy session with Ben or myself at www.pumpedonproperty.com, and we can kind of have a bit of a chat about your situation and how you can capitalize on the market at the moment and, make that decision whether you're going to or not.
Yeah, like I am always nervous personally. I don't like spending the money. I don't like seeing the debt in the bank. I don't know if it's going to work out short term for you or myself. We can never know that. Like I say to every client that we've ever worked with, in any year in the cycle, you could make 20%, you could have 10 years of your asset going flat, or with the declines in the assets, in some years, look at negative 20% growth. If you're a share trader, you could see negative 60% growth in a year sometimes. Like, we don't know what's going to happen short term, but what I do know long term is the government's reduced interest rates, the government's printing money, the government's spending money on infrastructure. There's a massive bailout program going in place now, which is going to sharpen the improvement in the economic system globally. America's spending money, Europe's spending money, Asia's spending money, Australia's spending money. There's just all of this money that wasn't here before, trillions and trillions and trillions of dollars is going to flow into the global system, and it's going to end up like we talked about before, in inflated share prices or inflated property prices down the line. So whether you think it's going to recover or not is irrelevant. It will.
Yeah.
The world completely blew up itself in World War I and World War II. Like, Germany and England were almost decimated to like vacant land again.
If you've ever been over to some of those cities in Europe that were blown up and you see the photos and the devastation, it was literally vacant land, like it was rubble.
And those places recovered. And who would have thought they were going to recover? Who would have thought that after World War I, the Spanish flu, World War II, the Great Depression, like what a horrible time of history, 25 years of just hardship, that things would happen. Like, who would have thought after World War I, where the countries and the banks and the governments were just so over leveraged in debt from financing that war, that we'd go on to the roaring 20s, and that would be, outside of the current bull market, the strongest run in history that we've ever seen. Like, it's just, you need to understand your history so that you can remember that things will be better in the future, so that you can remember that this time it's no different than it has been, that the world has been through hardships. 40 to 70 million people died in the Spanish flu. The world has been through these events before, and the beautiful thing about humans is we do come together in tough times. We do get ourselves out of it. The world will change for the better. People are slowing down. People are remembering what's important. And what's important to me is setting myself and my family up for the future and living my best life now. And that is a universal truth for every human in the world. Like, everyone wants a better future than what they've come from in the past, and that will always be the case.
Exactly. So make your plan, figure out what sort of life you want to lead in the future, and then scale it back to figure out what needs to happen right now in order to get a little bit closer to that goal. Constant, continuous improvement is what we're striving for.
Loved it, man. Hope you've enjoyed this podcast today. Please give us a 5-star review if you haven't already. Like, if that's not a 5-star podcast, man, I don't know what it is.
Seriously.
Have some fun with it, guys. If you haven't already done so, follow us on Facebook and Instagram, where we're giving like really positive, as well as really analytical daily updates, so that you can keep your finger on the pulse, but not run through the next 18 months scared as shit. Check out our YouTube channel and subscribe to that. I wish you all the blessed.
Yeah, I love that word. I wish you the blessed.
The blessed. Please share this with someone that needs to see it, because there's so many people at the moment that are either in a great position that don't know what the hell to do, or they're in a really tough position that just need some support. Be that person. Like, choose to live above the line through this particular time. Increase your energy level and rise up, and like, let's get through this together.
Definitely.
Cheers.